Hello and welcome to the How to Trade Like a Pro podcast. I'm Wieland Arlt, and in this episode I'm talking with Eddie Tofpik about commodities, technical analysis and trading. Before we start, please take a closer look to the risk disclaimer in the show notes. Now, enjoy this episode. I'm here together with Eddie Tofpik. Eddie Tofpik is the head of technical analysis and senior markets analyst at ADM Investor Services International Limited, to give the whole title. And you're also chairman of the Society of Technical Analysts in London.
Yes.
And my dear colleague from the board of the directors at the International Federation of Technical Analysts. Therefore, Eddie, I'm so happy that we have the opportunity to discuss trading, markets, analysis, life, and whatever comes to mind. And thank you for being here. Welcome to the podcast.
It's my pleasure to be here. Thank you very much, Wieland.
Eddie, it's really a huge honor because you bring so much experience to the table when it comes to technical analysis and commodities, because working for ADM means working with commodities. And I'm very curious, how did you start your journey being an analyst?
I can put it down to about 1985 or thereabouts, around about 85, early 85. I was a young broker. I've been a trader on bullion and I moved over to brokerage on futures. And the guy I worked with, his name was Keith Edwards. Everybody knew him as Eddie Edwards. So when everybody shouted at us, Eddie, both of us went, yeah, yeah. So he was a experienced broker in all the derivative markets, from financial service, from like the fixed income, through equities, stock index futures, through to commodities and to currency futures as well. He was the one who introduced me to technical analysis. And he did this because I was talking to him and I said to him one day, why are you doing this? Why do you do technical analysis? Because I was, naturally thought fundamentals is the F word, horrible word, the F word. That's where everything was. And he said, no, I do this because one day I will not be that good as a broker or a trader. And I am looking to have something so I can still have an interest in this industry. And I thought about that for a while, and I thought that's a very enlightened long-term point of view. So I started asking him and learning more about technical analysis. And he directed me to the one person that these two people have been essential to my technical analysis journey, adventure. He pointed me to Trevor Neal, which is a well-known technical analyst around the world, and introduced me to Trevor Neal. And between the two of them, they got me involved in technical analysis. Trevor introduced me to what was then called the Association of Chart and Technical Analysts, ACTA, which became the STA, the Society of Technical Analysts in the UK. And I joined it very early on, and I wanted to learn more. And that's where it all started from. That's the real beginning of my journey, was to give me something later on in my life when I know that maybe I'm not going to be, because there are plenty of good brokers and there are plenty of old brokers, but there are no good old brokers. So I knew at some point I wouldn't be that good as a broker or a trader, and I would then need to have something else to use while I still enjoy what I'm doing. And that's how I got involved in this.
That's interesting, because they're good and they're old, but no good old brokers. Yeah. And also same goes for traders.
Yeah.
Usually coming from the retail side, it's always like, okay, you have to progress, you have to learn, you have to make your experience, then become better and better as a trader. But now you're here saying, nah, I want to do something when I, get a bit older.
Yeah.
So why is that?
Because I still like what I do. I still get up early in the morning and I think, what's going to happen today? What am I doing today? Yesterday, I was writing about sugar and coffee. Those two main markets. I did foreign exchange and energy markets in the morning. and bullion. But I in the afternoon I specifically have it, and I wrote, and I spent extra time writing about sugar yesterday purely because it was interesting. It captured my attention and kept me, still going in this industry. And that's why I do it. That's why I get up and look. This is what I'm going to write about. This afternoon, I'll be writing about base metals, copper, aluminium, lead, zinc, nickel, tin. It's got my interest already.
I mean, also there's this question: why can you not be like more interested in being a broker or a trader as you have been as you grow older? Will it get boring, or will you feel like it's too speedy? I have to, to make too many decisions in too short amount of time? What is this? Because usually people feel like, okay, I want to start being a trader. I want to be a trader for the rest of my life.
It's like all things in life that when you start doing it, you're really enthusiastic. Then you become good at it. And then you think, well, what's next? What's after this? This is all there is. And when I started trading and I became, I ran books in foreign exchange and in bullion. I thought, well, is that all there is? Now I'm here. What do I do? Do I do this for the rest of my life? And that's it? There must be more than this. So, it's always trying to be a progression forward, always trying to go forward in your life. And I appreciate that. My enthusiasm when I was younger was I saw the traders, because I came from the back office. I saw the traders on the trading desk and I want to do that. I want to do that.
Yeah.
And when I did that, I thought, this is great, but this isn't all there is. There must be more. And then I learned about technical analysis and I want to do that now.
I get the point. So slowly
have a goal.
Yeah, slowly it's creeping into my mind, because so as far as I understand right now, it's like being a trader after a certain point, it feels like a little bit being very mechanical, just push a button and just execute. No matter what, you do what you do.
You lose the enthusiasm for it and it just becomes a job.
Yeah. And this is also some kind of different to being a retail trader, because retail trading for lots of people is most exciting as it can be, just because it's your own money on stake, right? Because I always feel like,
no, I don't think I wrote a paper on this, because it's not about money. If you're a retail trader, a lot of it is not about making money. If you're very disciplined, then it is. Then you become really good.
Yeah.
The fallacy, the trap that people fall into is primarily twofold. The first one is, this is brilliant. I can trade. I can move. My trade is going to matter. And you get that rush of hormones. And the second one is when you get it right. When you suddenly go, I'm going to go long of the euro here on the futures market or on the spot market or through CFDs or whatever. And then the euro goes up and then you sell and you make a profit. You think, that's great. I'm really great. I know what I'm doing. And the reward is not how much money you made. It's the hormonal effect in your mind.
Yeah. Sure. Which comes from kind of excitement and also like being right, like having control.
Exactly. Right. I beat the big guys.
Yeah. At least that time. But for this is the breadcrumb I got from the market.
Hopefully it's more than a breadcrumb, but I mean it's basically the whole point behind it is that you're giving it to the man. You're getting extra. The real part of the trading is when as a retail trader you learn the discipline of what to do, how to manage money, or how to manage your margins and everything. And that's the most important thing. And to detach from that emotive part of you, put your emotions aside and be singular and just thinking purely about, don't fall in love with your positions is a phrase I remember from many times. People love their positions. They go long. That's why I don't ever trade the market myself, because I would fall in love with what I believe is right. And I will keep talking about that despite what is going on in the market.
True. I mean, that's a bias you have. And also it gets colored in a certain way, like green or red,
Yeah.
it's very interesting because as a retail trader, most retail traders know themselves how things go, and always there's this question: how is it different in an institutional world? Being an institutional trader becomes boring. You just execute. You don't even do most of the analysis yourself. You just get it from the analyst, and then you just follow some kind of roadmap. Can it be? Is it like that, or how is
No,
it in institutional?
it's much harder. I mean, I'll speak about some of the things I've seen in recent times, and that is along the lines of the depth of analysis that's done. You don't rely on other people's analysis. Number one, you rely on to prompt you in a direction.
Yeah.
So that you look and say, oh, well, maybe I should look down this road. But the depth of analysis that's done in trading is much, much higher at an institutional house, purely because the access to information is much larger. So, and then you have to winnow out the good and the bad, and which is important and which is not important. It's not uncommon. One of the things that I've heard somebody, one of the traders at ADM say, he says, people get into positions for fundamental reasons, but they always use the technicals to get out. They always, because it's just the nature of that trading that, yes, you can go in with the technicals, but a lot of people also back it up with the F word. And it's a matter of being able to take it. And then you've got quantitative analysts when you're looking even down, you're drilling down to minutiae of what you're looking at. So, and to be a trader is different in an institution because you may be asked for a price all the time because you're not just a price taker, you're a price giver in a lot of situations. I remember on the bullion desk, you always had to be ready. You had an obligation to make a price. So you'd always have to be there to make a price. You may put a bloody great big double-decker bus between the bid and the offer, but you had to make a price. I mean, the volatility back in those days was much higher than it is now. So the spreads were much larger. And I remember trading during GW1 and GW2, Gulf War 1, Gulf War 2, and it was a dollar mark in those days, dollar Deutschmark. And I remember making, with no backing, 1 pfennig wide prices because the volatility was so large. And I had nothing else other than my own, my knowledge of what's going on to be able to make that price.
Yeah. Right. And then, of course, you have to hold that price no matter what.
Yeah.
Right?
You have an obligation to your customers to make a price. So you'd have calls all the time, people shouting over to you, whatever price it is in whatever, a lack of gold, which is 100,000 ounces of gold, silver, sorry, a lack of silver, 100,000 ounces of silver, or 10 bars of gold, which is 4,000 ounces of gold. You'd have to make a price in each one of those. And you'd hold it for a little while, out it, and they'd ask it again, repeat it, and you do it maybe 2 or 3 times. And then you get bored and tell the guy, what the hell do you want to do? Make your mind up. Yeah. And if you're really bored, if it was very quiet, you'd make a choice price, a bid offer at the same price, or occasionally an inverse price where the bid was higher than your offer. So instead of 50.55, you'd make 55.50. Sell me at 55 and I'll sell to you at 50 because I want to get something going here.
Yeah. Oh, that's quite a discount. Actually,
yeah, you can't hit both sides at the same time. You have to do one or the other. But it's sometimes you knew what was going on, and you'd always have shade your market according to how your perceptions were.
Now switching over to technical analysis, because it's also very interesting that you say, and as retail, once again, we are all in one person. You're the trader, you're the analyst, you're your own boss, right. And whatever comes to mind, your own investor into yourself. But going from trader to analyst is also very exciting. And you mentioned Trevor Neal, who is very well known, renowned in the technical analysis field, and he's still active.
Yeah, so, I spoke to him a few days ago. He was at the Society of Technical Analysts in London. We had our late summer party at the National Liberal Club. And he was there, and I spoke to him for a few times, and he is still active. He does it because he loves it.
Yeah.
He loves the people he speaks to. I mean, he has joy in his life.
That's what it's about.
Yeah.
Actually, it's not about, having a job, making money, how much it might be, but it's about enjoying your journey, whatever you do, right? So that's why also I love being a trader and analyst and all the stuff I do. I do quite a lot of stuff, but I do this for that reason, to enjoy it and to have fun, to meet people, to
I had a phrase somebody I heard a long time ago said, do whatever you really like to the best of your abilities, and you will be rich, and you might make a bit of money as well.
Which is true. Which is definitely true.
It depends on the road.
Yeah, riches is not always about money. People mistake this a lot. It's about everything in your life. So if you have a rich life, doesn't mean you need money, but then you don't need money or that much money, because you're rich anyway, in your mind and in your life. But bringing it back to technical analysis. So what caught you immediately the moment you were into technical analysis? What was like your first impression?
The one thing that still even now is it amazes me on occasions. I just suddenly sit and think, is that you can use technical analysis in every market in the world, and you can speak with authority because you know what's going on from other markets and how those patterns and things work. So somebody can show me a chart and say, make an analysis of that. And I'll do a chart, and I won't even need to know what it's about. And I'll do an analysis on it, and I'll give it over. And the guy will look at it and go, how the hell could you figure out just from the chart? This is what's going on. Because the chart says so.
Yeah.
I can apply similar disciplines to fixed income markets, to the bond futures markets. I can apply it to stock index and stock index futures. I can apply it to commodities. I can apply it to currencies. I can apply it to all sorts of markets.
Yeah.
I mean, I've been doing things such as carbon and butter, and what's trying to think some of the more esoteric ones, potatoes. I've done. So these are very niche markets in some cases. And but the rules apply because we're all part of the same. We're all humans. We're all getting involved in it.
True. I mean, when crypto came up, everybody was thinking about how to analyze it, make a chart.
I think I am the first institutional technical analyst who ever did an analysis of crypto. It was September 2015. The platform I use, which I'm not going to mention, but the platform I use had just 2 weeks prior to this started producing charts in Bitcoin.
Yeah. And
I produced my first analysis in September 12. I think it was around about $350 a coin then. And I remember, and I did it for, I still do it. I've updated my charts today on Bitcoin, and I've been doing it. And the one thing I've noticed about Bitcoin is the emotive effect it has on people and on cryptos generally. When I was saying that Bitcoin was going up, everybody went, yeah, well done, Eddie. Yeah. But then when I said, well, that's actually a temporary top that's going to pull back again. Oh, no, Bitcoin's going to go up forever. And I'm just trying to say to them, I'm just applying technical analysis. I'm just saying what the markets are saying. I'm not saying I personally have a view about it. I really don't care. I'm just trying to tell you dispassionately, this is what's going on. But that was nearly 10 years ago. And I don't remember there being any, I've still got the email to somebody out there, but I don't remember anybody else actually providing technical analysis on Bitcoin before that.
Yeah.
That's my only claim to fame.
Yeah, I mean, there are two things coming together. One is, okay, Bitcoin is gonna rise. Okay, everybody's in, applause. But then you feel like, yeah, but there's some kind of resistance, and will reverse and drop to whatever extent. And nobody wants to listen to this.
No.
I remember, like, recently I did an analysis for NVIDIA, and people are really like, "Oh, you cannot say this. You don't know anything." You
Well,
know?
there's a natural tendency, and this is about the psychology of markets.
Yeah.
There's a natural tendency for retail traders to buy and then sell.
Hmm.
They don't look at it that way.
Hmm.
They don't look at it the way, say, for example, futures markets, where you can sell and then buy later.
Yeah.
Because you're trying to catch the downside. And that's
Yeah.
the difference between, say, for example, somebody who's involved in the retail side, buy to sell later, which obviously comes from the equity market.
Hmm.
But if you're involved as in the professional side of the industry, your attitude actually is more to sell to buy later. That's one I think I've noticed. The professional institutional traders will look to sell to buy later, whereas the opposite happens for retail.
Yeah, I mean it's pretty obvious and easy to explain, because if you come from retail side and you're not so much into futures, so you always have to buy, because selling a stock, for example, you need. I mean, right now it's different. Also with
Yeah,
CFDs, it's different. But back in the
yeah.
days before
No.
this,
Well, the
you
only way
need to
you could
talk
do
to
it,
your bank. You need to land some stocks to sell them.
exactly.
It's ridiculous.
You'd have to be huge. You'd have to be like a Jesse Livermore or something to be able to sell and borrow stock all the time.
Yeah, yeah. But it changed with Forex, because if you sell
Yeah.
it, if you have a
Leo
Forex
Melmed,
platform,
and when he set up
right?
the futures markets on currencies.
Yeah, so you're long and short at the same time with different currencies. So this is something which changed the mindset, and then going over with CFDs or futures,
Mm.
you can with a click, you can go short, long, so you sell to buy and you buy to sell, and it changes the mindset. It's true. But also people always go, especially if they're into stocks. I think especially this is true for Germany, as far as I know, that people are not like buying stocks as a day trader. They're buying for swings, midterm, and
Yeah, they're
therefore,
investors. The difference between a
right,
trader and an investor.
right, right. They're kind of investors, and of course, they don't want to hear the message that it's coming over for a correction, for
Yeah.
some kind of selling. Nah, it's not true. You don't have any idea.
Well,
We
it's
have such.
interesting what you say, because that goes back to what I said earlier, which is don't
Yeah,
fall in love with your position.
totally true. Totally. And people defend their position always. Um, that's a story where all the crashes end up, where people
Mm.
feel like I'm totally broke because I was holding to that stock. Another Jesse Livermore story. But yeah. Um, tell me a little bit about commodities, because retail, they always know about commodities, but they break it down to very simple and classic ones. Oil, no matter which one. We have gold, we have silver. That's it, basically.
Well,
Some are looking at gas, but not really. So basically, these are the three most important ones.
the agricultural ones were where it all came from in the States and the US.
Mhm.
Wheat, corn, soybeans, that area, that's where it's come from. And it's obviously there's a lot of professional institutional players in there, because there are farmers trying to hedge their exposure from their harvests, and then you've
Yeah.
got processors who are buying it to then protect the price so they can then sell on to the public. The futures markets, when I started, I could name every single one of them, because there were only, I don't know how many there were, but I could remember every single futures contract and their codes. Now there are thousands of them. And the
Mhm.
growth has been not so much in the agriculturals or in the metals as such, but more in the energy products.
Yeah.
And energy is the biggest area. And there's a change going on at the moment where it's moving away from the natural one, which is NYMEX crude oil, Brent crude oil, heating oil,
Mhm.
gas oil, RBOB. It's moving more towards electricity futures, and obviously natural gas as well, because there's a change in our society in that area. It's moving away from the traditional carbon-rich fossil fuels, more towards a greener type of environment. So I think that's where you're going to see more interest in the world coming into it. But I'm still waiting for somebody, and there has been talk. I've been at conferences where I've been talking about this, that there are already hydrogen markets in some of the ports. They're run by the port authorities themselves, but there is yet to be a derivative in hydrogen futures, because hydrogen will play a big part in the next phase that we go through. Electricity is already there. It doesn't specify whether it's green or not green, but we already have electricity futures. They're very active. And we all know that sort of situation is going on at the moment. The commodity markets themselves, I think, are one of the basis from all charting, because if you go back to all technical analysis, actually, if you go back to where one of the origins of technical analysis is candlestick theory. And that goes back to about 1755, I think, Manesh Homer, where he wrote the 3 books, which I can't remember what they're called. They're the first books on trading, 3 Fountains of Gold or something like that. The 3 books he wrote. And that developed candlestick theory, which is one of the bedrocks of technical analysis. And I use it. I think we all use it in one way or another. So commodities is one of the places where it originated from. Now, in the equity markets, we had things such as point and figure develop, and all these the technical analysis and bar charts itself, and Dow theory. Dow theory wasn't ever in technical analysis. It was used as a insurance method, but it was by Charles Dow of Dow Jones fame. Dow theory is still used by a lot of people as a basis. I use it for development into the future of technical analysis. And so you look at commodities, and there is one of the core areas where it started from. And the futures markets are good because it allows you to see both players, the buyers and the sellers, showing it, because the difference between there and, say, for example, a traditional equity market is it's buy and hold. Whereas in futures, you can buy or sell. And it gives you a much greater, not volatility, I think, but more greater depth of what the market is actually doing. I started out in base metals, went on to precious metals, and that's where I came from. And then went on to oil. I ran desks in oil, metals, agriculturals. I ended up running a foreign exchange desk for 23 years. So it's an applicable thing in all markets that you can use technical analysis. The amount of time somebody shouts over to me, what's going on in this market or whatever? What's going on in gold? What's going on in silver? Where's the next support in euro dollar? And I'll look at a chart and give them an opinion. You can't do that to an economist. They'll say, well, the weighted value of the this and of that, whatever. I just don't want to know where the next support is. I don't want to know that, the history of the economics of the country. I want to know where the support is. And that's how I think technical analysis is different from other forms of analysis. It looks specifically at the market, it's not interested what made it do that. It's interested what it's doing. Whereas everything else is how we got here. This is telling you what's happening now.
Yeah, let me look at the GDP really quick.
Yeah, go on. You do that whilst I go and find a level for the guy. Here's something actually I think that for your retail viewers and listeners would be very interested to realize. And this is something that goes back to the 1980s. I worked for Dean Witter, which is now part of Morgan Stanley. And one of the things that Dean Witter were famous for was they had a very large retail base in the US. And they had a lot of activity. They were mainly a stockbroker, but they had a futures division as well. And one of the things that came across, and I was taught this back then, and I still think it's true, because I found some more information recently, which is very, very enlightening, was that retail comes in on the open, but the professionals come in on the close. So
like that.
The retails, we had so many dentists and doctors in Florida come in and buy whatever the hell it was on the open. But the professionals would always come in on the close. And I saw a piece of data recently. I can't remember where it was. I wish I could. And it was saying along the lines of, in the last half hour of every market, specifically commodities, but I imagine also the equity market as well. The last half hour to hour of the market, something like 70 to 80% of all the transactions take place.
Mhm.
And effectively, what you can do is look at it and go, I don't need to trade the whole day. I just need to trade the last hour of each market day, because that's where the greatest liquidity is going to be. That's where the professionals are going to be. And I'm going to see what's going to happen next. It's just something to bear in mind, but it doesn't work in, for example, foreign exchange. The last hour of foreign exchange between 9 o'clock and 10 o'clock in London is absolutely usually dead, because there's no data, there's nothing like that. Yeah. But in a lot of the markets, especially in commodities, because a lot of a lot of physical contracts are priced on the close of a futures market or a commodity market like the London Metal Exchange. You look at the certain closes, and all contracts, physical contracts, are based on that. So they'll look at a close. That's why the professionals come in on the close. And I'd love to see a piece of academic work, shall we say, analyzing how the effect of that is on somebody who just trades on the retail side on the close compared to somebody who trades on the open.
I mean, it's true. If you look at, especially if you go for the indices, especially US indices like S&P, NASDAQ, you look at the opening, everything is crazy. You feel like, what the heck are you doing? You know, you have huge candles changing color every 5 minutes.
Yeah.
And, you know, where's my direction gone, you know? So, but of course, everybody says, okay, you're going to go for the beginning, for the opening, you have huge liquidity coming in, but then you sit there being day trader, waiting for a signal, which doesn't appear for, let's say, 30 minutes minimum, because everybody's just struggling to find a direction, and you're destined to make mistakes and therefore losses.
Anytime you start waiting for something to happen,
right,
you're going to lose money. I think if you're seeing something happening and you can get on it, that's different. But if you're just sitting there going, I will wait, I will look, I will wait, I will look, and nothing, nothing happens, you're going to, in desperation, do something just purely because you want something to happen.
I mean, you nail it, because especially, once again, you're a retail trader, you want to make money with your trading. Maybe you have something else in mind as well for the day. You have an appointment, need to go to the dentist, whatever, but it has to happen now.
Yeah.
No, it's not working. And if so, maybe by luck, but not by, professionalism. And therefore, I can definitely understand that you feel like, okay, if I'm an analyst, I can pull out some charts, flip through the time frames, see what's going on, but I don't have any pressure, any need. I can always find something to look at and do something. And as a trader, you just wait, sit on your hands, surf the web, and it, as it always is, you're not looking at the chart, and that's the moment where everything happens, but you were waiting for hours.
Actually, I want to bring up something that you spoke about earlier about CFDs, etc.
Right.
When I started, CFDs did not exist. I've never run a desk in CFDs. I've been a trader in CFDs, a broker in CFDs, but I've never traded them. And primarily, I've done for my company, I've done stock CFDs. It's individual stock CFDs. The advantage of CFDs is very, very clear. Futures markets overall, it works on the basis of that, but it's an individual stock that you are participating in on leverage. And there are a number of things to bear in mind. One is the cost involved, because you're effectively trading a stock on margin. And every time you do that, there will be a cost involved. And, sometimes it can be quite high, because the demand for individual stocks at different times can be quite difficult. If the amount of times we've been asked, because we've been holding stock in a certain company, and we've been approached, can you lend us that stock? Because, we have customers who absolutely want to get involved, but they want to get involved through CFDs. And we've said, no, this belongs to our customer. We cannot lend this out to somebody else. So CFDs, when you do them, are actually very, very useful. They allow you a greater leverage and opportunity to participate in a move. Likewise, the losses on it as well. the main point is, unlike futures, your position is ultimately with the exchange, which is a AAA plus. It's higher rated than anything. If an exchange goes, then we're all in trouble. But if you have a position on an exchange, that a future, that's your position. Ultimately, is held by the exchange in one way or another. So if something goes wrong with your broker, then you can move that position over to another broker.
True.
With CFDs, it's not the same because it's a principal to principal transaction. So you're dealing with whoever your broker is. And so you have to be careful about the financial aspects of your broker to make sure that they are a good quality. They're they definitely have to be a regulated broker. There's plenty of CFD brokers who are not in regulated markets or in less regulated, less well-known markets. So my point is always to use a high quality broker wherever it is and regulated by a proper regulator, whether it's Germany, the UK, America, or Australia, or Asia, or Latin America, or wherever it is. It doesn't matter as long as they're a proper broker.
I mean, you're talking about a very important fact, and that is, what is a broker anyway? So you go with a CFD broker. Some were called market makers. Not so sure if this really appears right now, but it's people tend to, and this is also in comparison if you go with stocks. So you have just like a bank, you go with a bank, you have a depot, so you put your money in, you invest stocks, you have like 10 million over there. You don't do this with a CFD broker, right? So you go there with a couple of thousands maybe, you use the leverage, and that's it. And if the broker just gets broke, disappears, you just lose just a small amount of your money if you're lucky.
Yeah, but you still don't want to lose that money in the first place. So that's why it's worthwhile. And so many of these smaller, less reputable brokers offer humongous leverage, which I think is completely wrong. They should, the whole point, it goes back to the original money management point. You have to manage your risk and not, if it goes wrong, it will go wrong very quickly, very, very badly. So it's not just a few thousand you lose. It could be tens of thousands, hundreds of thousands even, depending on what it is.
True. Yeah, so speaking for Europe and some countries also, they took over that model of regulation. As a retail trader, you cannot lose more than you have on your account. This is limited for a reason, exactly for that reason, because it's, well, if you don't know what you're doing, most people don't know it, they tend to risk more than they can afford, number one. Number two, we saw this, back then we had the Swiss franc,
Yeah, I remember that.
The National Bank of Switzerland, they didn't interfere anymore at a certain point, and people were broke.
That was I mean, that reputation the SNB had after that. You'd think the SNB, Swiss National Bank, would be a safe, professional organization. It was run by a bunch of amateurs.
Yeah.
It was disgusting.
A rug pull, like you can expect just with some crypto scam, but that was really a rug pull.
Yeah,
for sure.
They didn't know what they were doing. I think that's the problem.
Yeah, so because of that, regulators, they changed it and said, okay, you cannot lose anymore. And what you have, you can just lose what you have on your account, but that's it. No margin call and nothing else.
Yeah,
and it's good to be this way. But if you claim to be professional and you go with futures, then still you have to, to pay off your margin. You have to pay off your debt.
Yeah.
And people have to be aware of this. So therefore, CFDs are a very good product if you know how to handle them, and if you go with the right broker for a reason.
Yeah. Yes. I agree.
So let's return to commodities, because for me also interesting, and also here we wearing the retail the retail glasses. What do you think? What are the commodities being best traded for retail, for swing trades, or maybe intraday trades? Gold as a classic, but it's more related to the US dollar than to anything else.
Well, yeah, I mean, no, actually, you say that the dollar hasn't really been moving, and gold has been making new all-time highs. Let's have a quick look and see if today's made a new all-time high. Hold on a second, just let me have a quick look.
It's almost like 2,000.
Well, just underneath. We're just underneath the all-time high. you've seen, you can look at some of the commodities, and I would say we're living in potentially either the tail end of an inflationary environment or in the middle of an inflationary environment.
Mm-hmm.
And inflationary environments always benefit commodities.
Yeah.
The humongous rise that we saw many years ago in crude oil, all the way up to the 150s and stuff like that, 180s, and then back down because of a technical reason to minus 50 or something like that, 30 on NYMEX. And then more recently, the move up because of what's happened in Ukraine, the move up in grain prices, oilseed prices,
mm-hmm.
that's been a really, really big move. And that's been an inflationary environment. Now, there's another piece of legislation. It's coming in at the end of this year. It's called the EUDR, European
mm-hmm.
Union Directive on, what's it called? EUDR. It's basically to stop the land being drawn out and from deforestation. The European Union on Directive Deforestation Regulation. European Union
right.
Directive Deforestation Regulation. It's not even a directive; it's a proper regulation. On the 31st of December this year, it will come into effect, and it means that you have to show a complete history for maybe, I think, 10 years in some cases, of what the land where you picked up the commodity from, whether it be wheat or corn or soybeans or timber or whatever it is, that you haven't deforested that part of the world. This has been responsible in a large part to the huge rise we saw in cocoa prices, and to a certain degree in the rise in coffee prices. And this is to do with how the structure of the market. Sugar is grown in big farms, huge places. I've been to Brazil many times. I've been over there. I've seen them. They are just huge places growing sugar. And so it's a very industrial process. You know, they come in great big lorries and do that. Coffee and specifically cocoa, but to a lesser degree coffee, is grown. Cocoa especially is grown in sort of small family plots in two major parts of Africa, Cote d'Ivoire and Ghana. And there are family businesses. You're telling those people now they have to provide certification that those land that they've been farming has not got, and they have to use computers and various things to do that, has not got, has no deforestation. There's been no deforestation. It's been used like this for decades. For the last 10 years, it's been used that way. Not a lot of them have that sort of access to documentation. Some of them may not be able to properly understand what the documentation they have to complete. And that's why you've had this huge rise in cocoa prices, because there's a worry that people are not going to be able to complete all the appropriate documentation to allow it to be put onto warehouse. So you have, that's a specific thing, but that's happened also in coffee. It's happened in some of the other commodities as well. These are all inflationary situations that have caused the market to rise, fall, rise again, fall, rise. And it's been more active in commodities now with a higher interest rate environment because of the inflation, trying to battle inflation. So I think maybe for another 2, maybe 5 years, possibly, commodities will be front and center in the eye of the big thing that's going on. And I'm not talking about just the crude oil price, which I actually don't think will be the one. I think gold is a good way of doing that because it's still a store of value. And when farmers in, if they suddenly have savings at some places, they're not allowed to participate in futures markets or other markets or Bitcoin or anything. They have to go into gold, and gold is being driven up because of that, amongst our various other reasons. So that's why I think commodities at the moment are front and center for a few years. There are, you're still getting good returns on the equity markets, but how far is that going to go? How many multiples are you going to use that? before you start looking, going, this is a bit high, this price.
Yeah.
Whereas commodities will go higher because there is a demand, not because you're anticipating who's going to be the next buyer beyond you. It's a looking at it and going, there is a demand for this. And so it's been really interesting to watch some of the markets move. We've had big cycles where the prices have gone through the roof and then come back down again. And now they've started to build up again in some of them.
Yeah. I mean, commodities, they're always been in the focus of investors. I just recall Jim Rogers, who was like the
I've got his book here somewhere,
of commodities, right?
Well, he's one of them. I mean, I always like Leo Melmed. He's the one who came up with the idea of currency futures on the CME back in the 70s. But Jim Rogers, I've got his book somewhere, Motorbiking Across the World on a BMW, I think it was, and an old bike.
Yeah, investment biker.
Yeah, that's it. I remember that. And he literally went through everywhere and got involved in everything he did, you know.
Mm-hmm. Yeah, so I mean, at the end, he has been right? Because meanwhile, there was so much. I mean, he had or still has a fund people can buy in, but it was not performing good for quite a long time. But right now, I haven't looked at it, but looking at the prices of commodities, especially gold, you mentioned cacao, you also mentioned coffee, and this goes on in a long list. At the end, he's right.
Yeah. I mean, he saw the potential that was going to happen from these things.
Yeah. Yeah. All right. So what is your suggestion? And this just to sum it up, because looking at the watch, we already go into 1 hour. And what is your suggestion for retail traders, but also, I mean, all kinds of investors or traders, whoever's interested in commodities, how to start, what is, how to approach, how to do analysis, how to do this?
Number one, wherever you are, contact your local technical analysis society. That's a member of IFTA. Above everything else, you will have for relatively nothing. I mean, the membership of the STA is less than £100, £85, I think it is. And it's similar across the world. You check on IFTA, on the IFTA website, where the societies are, and look to join one of them. You will get so much information for relatively nothing, for free almost, that you'll be able to have a basis of understanding of what you're doing. That's literally, you start from there. You will never know the fundamental picture the way that some of the big trading houses have, because their access to information is much larger. Unless you can afford $20,000, $30,000 for a screen to a year, you'll not even have part of that access. So the very first thing is to get that knowledge first. When you have that knowledge, dry run it. And then remember, retail comes in on the open, professionals come in on the close. Where do you want to trade? Do you want to trade at the beginning, where everybody else like you is supposed to be? Or do you want to trade where the professionals are, where you can see a greater depth of what's going on in the market? And look not just at a narrow world. If you think of just crude oil and gold as commodities, then what the hell? You've got no idea what's going on in the world. Cocoa prices, you'll only hear it. If you hear it on the BBC or on CNN, then it's too late. Or CNBC or Bloomberg, it's too late.
Yeah.
It's already happened. You need to look at these other markets and see them for yourselves and find it. Get a decent charting system. A lot of them are free that you can access, or give you free versions that you can access. Get a decent broker, a regulated broker, a proper regulated broker, and don't over leverage. Whatever you do, don't over leverage, because that's a killer. So that's where you'd start from. Go from there. Find people like you, or find people who are professionals who are interested in talking to you. Wieland, you're a great person. You teach so many people. Find Wieland, go with him. Find other people. I don't teach, but you find other people that can teach you and you can learn. That's where I'd go.
So kind. Thank you so much, Eddie, for all your insights, and also for giving us these tips, how to do it, what to look for, where all the price rising comes from if you go to supermarket and get a heart attack if you want to buy a chocolate. Right?
Yeah, but at least you know why it went up, and then you can say, okay, that's why it went up, and I should have seen that first.
Yeah, and you can hedge your chocolate consumption a little bit. But anyway.
I don't think anybody's going to hedge their chocolate consumption because there's not enough market expansion to be able to do that.
Yeah, maybe. Anyway, Eddie, great pleasure discussing with you for the conversation. Thank you so much for taking your time, for explain your experience also. I'm really happy to meet you once again next, especially live, maybe in London or somewhere else.
Yeah.
And until then, thanks again and all the best. Bye.
Thanks a lot.
That's already it, and I really hope that you enjoyed this episode and you took away some learnings for your personal trading. If you want to learn more about me, about my interview partners, if you want to have a one-on-one coaching or even get into a training course with me or my interview partners, just get into the show notes and follow one of all these links you find there, and then I will be happy to hear and see you again. Your Wieland Arlt.